Okay, so unfortunately for 90% of traders, finding a strategy can be quite simple, but the problem that they're facing is they don't understand the actual concepts behind their strategy. Now, I've been trading for upwards of 5 years and I've learned so many different concepts, but there was only one that actually stood out to me and is now being reflected in my trading plan today. So in this video, I'm going to teach you about the box cycle strategy that I've implemented into my trading plan to make me understand the concepts of market reversals easily. So without wasting any time, I'm going to show you the concepts that I use and then I'm going to show you examples on the chart so you can start implementing it yourself today. Okay, the box cycle strategy, what is it? It's effectively a form of accumulation, manipulation, and distribution. And I know that you've probably seen this concept so many times, but that's because it works. It's one of the one concepts that I've found which has actually held up for a long period of time. So what we first wait for is a form of accumulation. Now, before we start, this is actually known as fractal. And what this effectively means is this is happening on an all time frame. So whether that's the 1 minute, the 5 minute, the 1 hour, 4 hour daily chart, whatever it is, this cycle is happening on all time frames and it's happening right in front of your eyes. So for example, if we're looking on the 5 minute time frame, so let's say this is 5 minute, this would be Asian range. So that is a common form of accumulation. And that is because during Asian range, there isn't a big impulse of orders getting put in. So there's not really much volatility to the upside or the downside. So what happens is it forms highs and then it also forms lows. And the first step of an AMD model is to simply wait of a sweep of these highs or lows, which is commonly called a fake out or a manipulation. So coming out of Asian range, we have pre-London and we have faked out to the upside. Now, this is a form of manipulation and the clue is in the name. It's manipulating to the upside to get early buyers to think that the market is going to push higher. But what's actually happening is the liquidity of these highs, so all the orders that are rested at this peak, and this peak, they're all getting taken out. So the stop losses are being hit and the market has bigger ideas for the day of pushing lower. So bear in mind, like I said, this is fractal. So remember, these highs here, this could be a previous daily high, it could be a previous daily low, session highs, session lows, or just swing highs and swing lows. These are the three forms of external liquidity that we should be using to find our accumulation. So accumulation happens, we sweep above. Now what we need to do is wait for a confirmation that we're going to be going further down. And this can be done in many ways. I'm going to break down the way that I use personally, but it can be a market structure shift, an inverse fair value gap, whatever you want to use, there is a few ways to spot it. Now, what happens in the distribution phase is we actually push lower to where the market direction is actually wanting to go. So this could be brought out with our daily bias. So for example, if we're looking for sells, this model right here is extremely valuable to us. But I'm going to explain every single concept behind this and how you can capitalize on it every single day, just like us and our team do. So firstly, let's break down. The higher time frame, we're going to be looking for our buyers, whether that's the weekly, the daily, or the 4 hour. So this is where we just simply mark out our highs and our lows. So whether there's a weekly high or a weekly low, we're going to wait for a sweep above that. Our middle time frame, such as the hour, the 30, or the 15 minute, is where we're going to be looking for a setup. Now, I know it seems like a very high time frame to be looking for setups, but we do actually lower the time frame and refine when it comes to the entries. And this area here on the middle time frame is mainly going to be for our sweeps of liquidity. So the box cycle strategy, step one, wait for a manipulation out of the accumulation area. Like we said, if this is Asian range, we want to wait for a sweep above or below this area. So if that happens, you've completed step one. Step two, we're going to wait for a shift in market structure. So on this example here, it actually shifted to the upside. So you can see here, we've swept the liquidity of Asian lows. We had a break of structure to the downside, so we've manipulated down. And then we've had a strong push up to the upside, forming a market structure shift or a CISD. This is step two of the strategy complete, and we literally move on to step three. It is so simple. Now, we wait for a retracement back down. So say our shift was here. This is the way I do it. I wait for a shift down back into a fib area, and then I enter straight off the reaction. Now, there is a few things that you can do. For example, if we have an inverse fair value gap here, or a fair value gap that's formed, you can wait for that to be inverse and you can actually enter off here and you'll probably get the same entry as on a fib. I just like to wait for a shift to the upside because it's more of a confirmation that we do want to push higher. On my shifts as well, I will just put out there, I do like to see momentum. So for example, if we're pushing down quite softly, like this, I like to see a strong push to the upside, just to show that we have momentum into that direction. So yeah, that's that step. And then we have an extra step, which is an SMT. Now, if you don't know what an SMT is, all you need to do is look for the previous low that was formed on correlating pairs. So in this example, I'll use Euro USD and GBP USD. And you want to mark out the time. So for example, if we have a low formed at 8 a.m. on both Euro USD and GBP USD, we want to see the leading pair. So in this case, EU, take that low, but GU doesn't take that low. Now, this is an early sign that we're going to push higher. And it just shows that GU doesn't need to take the lows while EU does. So you can basically use this as one pair. So you can validate your sweeps of lows by looking at an alternate pair, which in some cases sounds a bit crazy, but it does work. So just before we get on the chart, I'll show you the narrative. So I'm simply aiming for 1 to 2s, and my targets are previous session highs or lows, previous daily highs or lows, or external swing points or higher time frame imbalance areas. Now, if you're looking for the two confluences that I do use, and I go more in depth about internal liquidity and external, I do have a full video going through it, so I'll mark that somewhere at the top of the screen, but make sure to watch that as well. It's got some really good value. Now, my stop loss must have good clearance of the market structure shift leg high or low. If the 618 doesn't clear, I lower my entry to the 786 or the 0.7. So if I have my entry at the 0.6 and my stop loss couldn't clear this low, I'd simply move it down a level so that it did clear, because if we do break this low, this is the area where I'm invalidating this trade. So if we're working within this area here, it's still valid. If we're working even just to the stop loss, it's still valid. But as soon as we come below this low, that's the trade invalidated for me. And I wouldn't be annoyed if it still came through after that. For me, that is just invalidated. So that is pretty much the strategy as a whole that I use. It's a simple AMD setup. So what I'll do is I'll get on the chart and I'll show you exactly how I implement it on a daily basis. Okay, so I'm on AUD USD on the 5-minute time frame here. And as you can see instantly, Asian range has a form of accumulation. Now, let me just draw that out so you can see. So Asian range accumulated towards the back end. Obviously, we still had some impulse of volume due to it being back end of New York, but the most part of Asian range we were actually accumulating. So I've simply marked out the high of Asian range, which is here. And all I want to see is a fake out of these highs or the lows. It doesn't really matter which way I was looking for because it's completely mechanical. But in this case, on the higher time frame, we were moving to the downside, so I was waiting for a sweep above. And just before London Open, we actually swept above these highs. So that is step one of the strategy done. We've swept liquidity to the upside and we're following the trends. We've had our accumulation, we've had a manipulation, and now we want to see a form of distribution to the downside. So I need to now confirm that this is going to happen. And this is where I implement the two-step strategy that I've also made a video about, so make sure to watch that, but briefly I'll go over it. So we simply have forms of highs and lows. Let me just get my highlighter out. So we're forming higher highs and higher lows, higher high, higher low. And then what we did is this was our last low here and we swept below that. So we had a change in state of delivery here. And all I needed to do now was draw a fib leg from the high to the low of this leg, which was formed here by this, marked out by this fractal. And I simply wait on a retracement. So I mark my short position at the 0.618. With a 10 pip stop, I can clear the highs, which is perfect. And then I simply target a 1 to 2, which for me in this case is 20 pips. And as you can see, this came through extremely quickly. It was a zero drawdown trade. But let me go on another pair just to show you how effective this actually is. So as you can see, this trade came through. It was super, super simple. All we wait for is a sweep above this accumulation. So we had a fake out, we had a shift to the downside. That was our confirmation that we were going to go lower. And I just waited for a retracement to rebalance this leg. And then we pushed further down to the session lows. Now I do have fixed RR trades, so mine is simply 1 to 2. But if you want to target the previous session lows, that is absolutely fine. So let me just get another example up on the chart so I can show you it working through again. just so you can see how effective this actually is. Okay, so this is another example. This is AUD CAD. So again, we had our accumulation form here. We then had our manipulation to the upside pre-London, and then for London session, we had our distribution to the downside. Exactly the same entry model. So we had a push to the upside, higher high, higher low, higher high, higher low, higher high. And then we formed a lower low here, which was our shift leg. I marked my fib from the high to the low, waited for a retracement to the 618. We had a 10 pip stop, which actually cleared these highs here. And I simply targeted a 1 to 2, which again, 20 pips. So if you're trading this on prop firms, it is such an easy way to capitalize. And you can even go further and target, again, the session lows. There's some internal liquidity down here that you could target. There's external lows here. It is so lucrative on how you can actually trade this strategy, which is great. And this is the one concept that I've used day in, day out for the past 2 years, and I've had such good results from it. So that is why I'm teaching people this strategy daily. So yeah, that is the one concept that really changed my trading for the better. So I hope this video has been valuable to you, and I hope you can implement it and understand how market reversals actually work. Remember, if you do like the channel, make sure to subscribe and turn the notification bell on. That helps us out and it helps boost the views and gets us onto other people's pages. But yeah, we have new videos coming out every single week, so make sure to keep your eye out for that. But yeah, that's it for this video. I'll see you in the next one. Peace.